Hi everyone, welcome to this video. Into this video we are going to go over universal life insurance. First, I would like to explain what universal life insurance is. Then we go over some key points in the explanation. Then from there we dive deep by explaining using graph and something more visual on it. So what is universal life insurance? Universal life insurance is an insurance policy where you pay a premium that covers both your death benefits that will be paid to your loved ones after you die and an accumulating cash value. So that is just the basic explanation of universal life insurance. You pay a premium, then the premium will be divided into two different parts: your death benefits and accumulating different parts. Your death benefits and accumulating cash value. Oftentimes, universal life insurance enables you to pay a premium, and after maybe after the premium lapses, you still have that insurance in some way. So I will explain deeper so that you understand more about it. First, what are the key points here? Key point here is that you pay a specific premium every month usually, and the premium will be divided into two, like I said. And the first part of that premium will be the cost of the actual insurance that we enable the insurance company to pay specific death benefits to your loved ones after your death. This cost of insurance is taken by the insurance company, right? And the second part is the accumulating cash value, which goes into a side account created for that insurance policy. So the last thing, which is the key point that I would dive deep on, is as is illustration. I believe you understand this after I explain these first three. So with that, let's go into graphical explanation so that you understand the whole picture in a clearer detail. So if you look at this chart, the orange line signifies the cost of insurance. Oftentimes the cost of insurance increases. That's just how it is. The cost of insurance increases maybe yearly due to the rate of the interest rate. Cost of insurance increases, but you won't have your premium increase. Maybe you are paying a $500 every month premium, and maybe the time you started this life insurance policy, the cost of insurance is at $300, and you are paying $500. So obviously $200 every month will be going into an account, which is the side account. You might not know this, or if your advisor explains to you, some part of your premium will be going into the side account while you continue to pay for the actual cost of insurance. So the premium will be divided into two and the payment will continue. But because the cost of insurance increases annually, you get, so maybe at the third or 20th year of you starting this policy, the cost of insurance has rise to maybe $350. That means the money that will be going into your side account will be lower than the money you started with, and eventually the cost of insurance will be equals to the actual cost of will be equals to the premium you are paying. So in this case, nothing will be going into the side account, and because, like I said, cost of insurance increases annually, definitely at a point the cost of insurance will be higher than the premium that you are paying. So in this case, the insurance company will not call you. Oftentimes they will not call you, they will not tell you anything. They will only go into your side account to complete the cost of insurance you're supposed to pay. Let's say at year 35 year you are supposed to pay $600, But because you don't know that, and the insurance company did not tell you, you still pay your $500 that you've been paying all these years, and they will take out of your side account to complete the cost of insurance. And this will continue like that until your side account is depleted. You have nothing left in the side account. It is then that the insurance company will call you that, oh, hello, Henry, you need to add to your premium that you paid this year because, or that you paid this month, because your cost of insurance is way higher than the premium that you are paying. And oftentimes, a lot of people will be surprised because this is what I've been paying all these years, and I believe that I should even have some money in my, because you are not aware of the state of the whole picture. Because most people will not seek advice after paying, after, because they are used to paying such amounts. So you will be surprised, and oftentimes this will happen in later years. Maybe the owner of the account is old. If you look at it, maybe the person started this universal insurance account at year, maybe when they started it, they were like 40 years old. Going to this place, they are like over 70 years. This is the time that they need the account most. Maybe they need to leave it to their children, like to leave the benefit to their children, or to like do something with it. So that's when the insurance company is telling them that no, your account is depleted, your side account is depleted, and for you to continue this policy, you need to add more to your premium. So oftentimes, some people might just feel like, I can't do this, and that would be like a disaster to them because they are old. Oftentimes, nothing is coming in for them anymore. They won't be able to increase the premium. So to solve this issue that might occur later on, there's something called as is illustration, and this may be on this usually come in place when you seek advisors on your insurance policy. The advisors will do something called as is illustration to feel like in 10 years to this time, this is what will be in your side account, and this is what you might need to be paying at that time. So what this does is that they use it to foresee what will happen in the future. So they use it to calculate like educated guess, to make an educated decision on what your insurance policy will be. So after calculating the assist illustration, the advisor might tell you that in like year 30, your premium will be equals to your cost of insurance, and that will be taken out of your side account, which you don't want. So to avoid that, maybe you should increase your premium to like $600. Maybe you did the assist illustration on the 20th year, so from there you increase your premium to $600. So now the cost of insurance will be equals to the premium at year, let's say year 35. You get, so that you have more in your side account, and again you are going to avoid this the story that touch moment. You are going to avoid it, or maybe increase the year that is going to occur. So that's just the simple explanation of what universal payment to be divided into two parts: the cost of the actual insurance for death benefit, and the cash value that will be going into a side account. And you can even take out of this side account, you can borrow from it, you can like use it depending on the need that you need at a particular time. But most importantly, you are using it for later stages in your life. Just make sure you like, subscribe, and stay tuned for our next video. Thanks.